This video covers the effective use of probabilistic forecasting models in the areas of hurricane preparedness and investment management. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Unfortunately, events occur from time to time in nature and in the financial markets that can adversely impact the physical and emotional health of human beings. In this video, we'll focus on two real-world examples. Number one, the day that Lehman Brothers filed for bankruptcy on September 16, 2008, from the Wall Street Journal. The American financial system was shaken to its core on Sunday. Lehman Brothers Holdings filed for bankruptcy protection, and Merrill Lynch and Company agreed to be sold to Bank of America. From a New York Times article dated August 26, 2017, Hurricane Harvey bombarded a stretch of the Gulf Coast in Texas on Saturday with home-ripping winds and epic rains. If you Google the title of these articles, you can find the complete text on the internet, which will provide a little bit better understanding of the adverse emotional and physical impact that these type of events can have on humans. Fortunately, probabilistic forecasting models can help us mitigate some of those adverse impacts. Hurricane forecasting models use observational data, which describe the current state of the atmosphere, as input for mathematical equations that produce one or more forecasts. Stock market forecasting models use hard data, data which describes the current state of the financial markets, as input for mathematical equations that produce one or more forecasts. Hurricane tracking and forecasting models typically use numerous submodels to determine the projected path of a hurricane or tropical storm. Facts are entered into each of the submodels, and each of the submodels produce what's known as a probabilistic forecast. Typically, the forecast that we see on TV is a weighted average forecast based on the output from multiple submodels, allowing forecasters to predict with a reasonable degree of certainty where a storm may make landfall. When probabilistic forecasting models are used in the area of hurricane preparedness, hard data is collected that describes current atmospheric conditions, and the data is used as input for numerous mathematical models. With the latest model runs in hand, forecasters and government officials can answer a relatively simple question. Based on the facts in hand, have we issued the proper guidance to the public? If the answer is yes, typically no new action is needed, or they can choose the do-nothing alternative. If the answer is no, they can issue the proper guidance to the general public. And since weather systems are far from static, the process must be repeated, meaning the latest data is plugged into the mathematical models, allowing for the same question to be asked again. And the only way that forecasters and government officials can answer this question prudently is if they maintain an open and flexible mind about what may or may not happen next. A weather system could strengthen and become more dangerous, or a weather system could become weaker, mitigating some of the risk to the general public. While it's typically not a matter of life and death, in the investment world, probabilistic models are used in a very, very similar manner. We take hard data, or a set of facts, and plug them into numerous probabilistic forecasting models. In the investment realm, the forecasting models actually help us better understand the probability of good things happening relative to the probability of bad things happening based on facts. Once we have a much better and firmer understanding of the stock market's risk-reward profile, we can ask ourselves, based on the facts that we have in hand, are we allocated properly from an investment management perspective? If the answer is yes, or we're not sure, we choose the do nothing alternative and leave it alone. All things being equal, we would prefer to trade less rather than more frequently. And if the answer to the question, are we allocated properly based on the facts in hand, is no, we can make an incremental adjustment to our portfolio allocation to get back in line with the hard data and the market's current risk-reward profile. In order to properly use these models when the stock market closes, we take the attitude that we have no idea in terms of what's going to happen tomorrow or in the coming weeks and months, and thus, like the meteorologists, we must consistently repeat this process. And it's incredibly important that we do so with that always flexible, unbiased, and open mind. At any time, we can take a snapshot of the market's current profile by collecting hard data, putting it into the mathematical models, allowing us to prudently ask the same question. Based on the facts in hand, are we allocated properly? As we move forward, it might be helpful to note when a tropical depression strengthens to a certain point, it becomes a tropical storm, and when a tropical storm strengthens to a certain point, it can be classified as a hurricane. While both investment and weather models are looking at the probability of future outcomes and a wide range of outcomes, sometimes the term probabilistic forecasting can be a little bit confusing. As we step through the real-world example of Hurricane Harvey, we can see that in actuality, hard data and facts are plugged into a model, allowing for an assessment of facts, current conditions. That assessment of facts and current conditions can help forecasters and government officials decide whether or not action is needed or whether they can choose the do-nothing alternative. This is a tweet 11 days before the eventual hurricane hit landfall from the National Hurricane Center Atlantic Operations Twitter feed. The basic gist of the tweet is as follows. Based on the facts that we have in hand, it is prudent for us to pay closer attention over the next 5 days or so. And since this represented a different and new set of facts, some guidance was issued to the general public. When they plugged the latest data into their forecasting models roughly 24 hours later, they once again felt that some guidance was prudent, with the tweet telling the general public that they were tracking 3 disturbances in the Atlantic Ocean with a chance of formation over the next 5 days. 8 days before the hurricane made landfall, they decided to send an Air Force Hurricane Hunter plane to collect the latest data. Later that same day, they took the latest data and entered it into their forecasting models. And just a few hours later, with fresh data and fresh output from their models, when they asked the question, based on the facts in hand, have we issued the proper guidance to the general public? In this case, the answer was no, and they acted accordingly, telling the general public that the disturbance had become Tropical Storm Harvey. 5 days before landfall in Texas, the hard data and facts in hand, coupled with the output from their forecasting models, told them Harvey's remnants are likely to become a tropical cyclone again. And as we move forward, we should keep in mind, once a tropical cyclone reaches maximum sustained winds of 74 miles per hour or higher, it is then classified as a hurricane, typhoon, or cyclone, depending upon where the storm originates in the world. Long story short, for our simple illustrations, the terms hurricane, typhoon, and cyclone are synonymous. And notice when the data changes, the terminology that they share with the public changes as well. 5 days before landfall, likely to become a tropical cyclone. 4 days before landfall, a high chance of a tropical cyclone. So in roughly 24 hours, we move from likely to high chance. And this tweet here, 3 days before the hurricane made landfall, highlights the wonderful work these forecasters are doing to assist the general public. 87 hours before hurricane landfall. The tweet says, interests in northeast Mexico and Texas should monitor. Basically saying, if you live in northeastern Mexico or in Texas, it's time to really start paying attention. There's no question that numerous investors in the United States and around the world would have loved to have received a warning tweet 87 hours before Lehman filed for bankruptcy in September of 2008. And another similarity between weather forecasting and investment management are terms such as likely, possibly, and could. All of these terms acknowledge the probability of good things happening is never zero, and the probability of bad things happening is never zero. Likely, possibly, and could help forecasters maintain that open, unbiased, and flexible mind. 81 hours before landfall, based on the current data in hand and the output from their forecasting models, the tweet clearly states multiple hazards to portions of the Texas coast could be coming as soon as Friday. Just as the terms that we use with our clients help us all get psychologically prepared for possible chess moves in the investment realm, forecasters and government officials use different terminology when the hard data and facts in hand change. In this case, the guidance to the general public shifts from likely to very likely. Understanding that it's extremely important to have the best data possible and to continually update that data, the Hurricane Hunter aircraft was sent out again roughly 2 days before landfall. In previous tweets, we've seen likely, very likely, and now as the storm gets closer, we see near 100% chance of regenerating to a tropical cyclone. Said another way, the message to the general public is we're not fooling around here. This is serious. This tweet here on August 23rd at 8 a.m. speaks to discipline. They're not jumping the gun here. The hard data and the facts that they have in hand do not warrant putting watches out or a hurricane watch out at this time. But they have seen enough in the trends and based on their experience to say we may be issuing a hurricane watch later today. This tweet on August 23rd once again reflects discipline and the ability of forecasters to keep an open mind about all outcomes. They're not making any assumptions about whether this storm will strengthen or weaken. They're looking at the hard data that they have in hand and making decisions based on those facts. In the tweet that we're currently reviewing, they're acknowledging that the storm could weaken and be reclassified from a tropical storm and downgraded to a tropical depression. They're not making any assumptions about moving to a hurricane classification. If the data changes and calls for classifying it as a tropical depression, they will do so, telling us, just like in the investment world, it's extremely important for them to keep their ego and personal opinions in check and remain open-minded and flexible and willing to react to changes in the hard data and facts, rather than making assumptions or forecasts about what's going to happen next relative to the data. That's a big difference between probabilistic forecasting and forecasting in general. Typically, a forecast says, I think the stock market's going up. A probabilistic forecast always hedges it with some type of probabilistic statement or mathematical equation. 2 days before hurricane landfall, they're warning the hard data in hand is saying there's a chance for significant rainfall. 59 hours before landfall, when they asked the question, have we issued the proper guidance based on the facts in hand, the answer was no, and hence they issued a storm surge watch. Over 2 days before landfall, the communication with the public, this rainfall could cause life-threatening flooding. roughly 48 hours before landfall, we see another example of keeping an open mind and remaining flexible. When the Hurricane Hunter aircraft went out and gathered the latest data, they found that Harvey had not yet strengthened. They never make assumptions about what's going to happen next, only probabilistic statements based on the facts that they have in hand. The morning of August 24th, when they asked the question, have we issued the proper guidance based on the facts that we have in hand, the answer was no, and thus a hurricane warning was issued. This time, when the Hurricane Hunter plane gathered the latest hard data, it did find that the storm was strengthening. 39 hours before landfall, a hurricane warning and guidance that preparations to protect life and property should be rushed to completion with an exclamation point. Once again, the hard data and the output from their forecasting models is telling them that this storm should be taken very, very seriously. And while it's a much more muted event relative to a catastrophic hurricane that involves life and death, it still would have been very, very helpful and would have added to the quality of people's lives if 39 hours before Lehman filed for bankruptcy, some type of probabilistic warning or red flag was raised. Notice the day before landfall, we're not using terms like likely, could, or possible. We're using is expected to produce. About a day and a half before landfall, their forecasting models told them that up to 30 inches of rain was possible, which could cause life-threatening flash flooding. And unlike the financial markets, in this case, their forecasting models and guidance unquestionably saved lives. About 36 hours before landfall, the wording becomes much stronger, and we start to see less of possible, likely, and could. Just as monitoring the hard data and the facts in the investment world can help us prudently prepare for unfavorable or low probability markets, the hurricane forecasting models told people you need to prepare today because the winds will be too high for preparations tomorrow. 29 to 30 hours before landfall, the data that they have in hand is allowing them to make relatively definitive statements such as devastating and life-threatening flooding is expected, meaning it would be surprising if devastating and life-threatening flooding did not occur at this point. It's expected. Landfall is still over 24 hours away, and they're alerting the public that we could get up to 35 inches of rain over the next 1 to 7 days. From a preparation perspective, one of the reasons why discipline is so important, it's very, very difficult to think clearly when you can see the storm so close to landfall. Panic has a tendency to set in. In a similar way, in the middle of a financial crisis, when account balances are plummeting, it becomes very, very difficult to think in a clear and prudent manner, and our emotions tend to take over. With about 8 hours before landfall, the storm is upgraded to a Category 3 hurricane, and roughly 6 hours before landfall, the hard data that they had in hand allowed them to make this definitive statement: Harvey will make landfall tonight. Roughly 4 hours before landfall, the storm is still intensifying, and when they ask, have we issued the proper guidance, the answer was no, and they upgraded the storm to a Category 4 hurricane. Unfortunately for the residents of Houston and the surrounding areas, Hurricane Harvey did make landfall at roughly 11 p.m. Eastern Time on August 25, 2017. Using hard data and facts and probabilistic forecasting models, 11 days prior to landfall, the National Hurricane Center basically said, we have some data in hand telling us we should pay a little bit closer attention over the next 5 days or so. And in this table, we can see how they use the hard data and facts and output from their models to update their guidance to the general public, which unquestionably saved hundreds, if not thousands, of lives. And while it's a much more muted event relative to a life-threatening hurricane, most investors would agree that it would have been nice to see something like this 11 days prior to Lehman's collapse. In the case of the weather system, landfall was made on August 25th, and 11 days prior to that, this was the tweet that said, based on the data that we have in hand, there's a medium chance of something developing over the next 5 days, providing us with hard evidence of the outstanding work that's being done at the National Hurricane Center. Another parallel between weather systems and investment management, just as forecasters are constantly improving their models and ability to alert the general public, we are constantly looking for ways to improve our probabilistic forecasting models. Before we move on to the investment and Lehman example, we should point out something else that is similar between the two applications. From hurricanescience.org, they're noting when they're explaining how hurricane forecasting models work that it's a simple example. And they also note, in reality, hurricane forecasting models are significantly more complex than what they're showing here. But the concepts are the same in reality relative to the simple example. All of that applies to our weekly videos and this video. We're going to be showing some simple examples to illustrate basic concepts, but those concepts apply to the more complex CCM market model. And for our purposes, we would prefer to replace the word forecast with the concept that the output is used to help us determine whether or not we need to take action. Thus, to illustrate how probabilistic forecasting models could have helped thousands of investors prior to the collapse of Lehman, let's go back to our normal 30, 40, and 50-week moving averages that we use for illustrative purposes only, to illustrate basic concepts used by the much more complex CCM market model. So weekly chart of the S&P 500 here. This is the topping process in 2007. This is what we call a full bore and favorable full bore bullish look with price above all of the moving averages. Blue, the fastest moving averages on top, and the slopes of all of the moving averages are positive. We can see this, measure it, and put it in a model. Conversely, this is a full bore bearish look with price below all of the moving averages, with blue, the fastest moving average, now on the bottom, and the slopes of all of the moving averages are down. We can see this, measure it, and put it in a model before really bad things happened. How did this exact same chart look before Lehman collapsed? As noted in the September 16, 2008 Wall Street Journal article, the financial system was shaken to its core on a Sunday. It was Sunday, September 14th. Lehman actually filed for bankruptcy on Monday, September 15th. Therefore, for a probabilistic forecasting model to be helpful, we would have had to have seen observable evidence before the stock market closed on Friday, September 12th. And as we can clearly see, our 30, 40, and 50, for illustrative purposes only, weekly moving averages were waving yellow and red flags 6 to 9 months before Lehman collapsed. We shift from a full-bore bullish look to a full-bore bearish look. We never shift back to a full-bore bullish look, telling us this is volatility to ignore within the context of an ongoing downtrend. Therefore, if we go back to our flow chart, if we ask the question based on the facts in hand, are we allocated properly? The answer in an incremental fashion based on this one example would have started to say no in some cases, starting 9 months before Lehman declared bankruptcy. Roughly 6 months before, we had a full-bore bearish look with price below all of the moving averages, blue on the bottom, and all of the slopes were down. How about the Nasdaq? This is the look we want to avoid. This is the full-bore, I can see it, measure it, and put it in a model bearish look that was present the Friday before Lehman collapsed. Yellow and red flags were waving based on hard evidence. No forecast was necessary 6 to 9 months before Friday, September 12, 2008. How about the Dow? This is the look we want to avoid. This is the full-bore bearish look on Friday, September 12, 2008. Remember, we're using simple examples to illustrate more complex concepts used by the model. How about our monthly MACD? We've covered numerous times in our weekly videos. This is the look that we want to avoid. This is a bearish rollover look. We want to avoid this. This is the look we want to embrace. How did the exact same chart and indicator, monthly MACD for the S&P 500, look the Friday before the collapse of Lehman Brothers? The answer is it looked absolutely positively ugly. And the bearish cross came well before. We could see this, measure it, and put it in a model before the calendar flipped over to 2008. How about asset class behavior and monthly MACD? When the stock market was peaking, here's our bearish cross here in October of 2007 when we're looking at the performance of the S&P 500 relative to long-term treasury bonds, or SPY relative to TLT, in the ETF world. This is the bullish long-term momentum look that we want to embrace. How did the exact same chart look the Friday before Lehman Brothers collapsed? The answer is absolutely, positively ugly. Red flags were waving several months, almost a year before Lehman declared bankruptcy, citing evidence that the hard data was telling us the collapse of Lehman Brothers was hardly a black swan event, at least from a probability perspective. A fair question and counter argument might be you're using very, very long-term signals here. Remember, we said our weighted average forecast for the path of a tropical storm or hurricane was based on multiple inputs or multiple probabilistic models, and this is a weighted average. We do the exact same thing. The master market model is made up of multiple submodels, including a trend strength model that asks 207 binary questions about the health, the current health of the financial markets. It uses multiple time frames, short, intermediate, and long term, and it uses multiple inputs. Thus, these simple examples are representative of the more complex concepts that were captured by the master model. Thus, the fair question really is, if I looked at multiple time frames and multiple inputs, would they have been helpful prior to the collapse of Lehman Brothers? Said another way, what was the percent of the binary data tracked by the model that was bullish the Friday before Lehman Brothers? And of course, the answer to that question tells us a lot about the market's current risk-reward profile based on the hard data that was present on Friday, September 12th. The answer to the million-dollar question is 0%. For the most part, 100% of the 207 questions, based on a weighted average that were asked Friday before the collapse of Lehman Brothers, 100% of them were saying the stock market is not a good place to be from a risk-reward perspective. We could see that, measure it, and put it in a model before Lehman Brothers collapsed. A sound probabilistic forecasting model in the investment world should be helpful in both bullish and bearish situations. As we can see, as of Friday, September 8th, 2017, the S&P 500 still has a full-bore bullish look, and this still looks like a strong and sustainable long-term uptrend. That statement is based on the facts that we have in hand today. We're not making any assumptions about what tomorrow will look like. Therefore, when we ask, are we allocated properly based on the facts that we have in hand today, the answer on September 8th was yes. Similar situation for the Nasdaq, September 8th, 2017, full-bore bullish look. And just as these concepts are helpful on September 8th, 2017, in terms of assessing the probability of good things happening relative to the probability of bad things happening, these same concepts will be helpful in the year 2025, 2050, or 2075. How does long-term momentum look as measured by monthly MACD on Friday, September 8th, 2017? The facts that we have in hand unquestionably look more like the look we want to embrace near a bullish turn rather than the look we want to avoid near a major stock market top. Once again, in the present day, in September of 2017, you can make the argument you're looking at very, very long-term indicators. And just as was the case back when Lehman collapsed, when we're looking at these charts in September of 2017, they are representative of the concepts used by the market model. Bringing us to another fair question. What was the percent of the binary data tracked by the model that was bullish on Friday, September 8th, 2017? And of course, the answer will give us some insight into the probability of good things happening relative to the probability of bad things happening in the coming days, weeks, months, and years. On Friday, September 8th, 2017, 100% of the data tracked by the trend strength model, a submodel of the master model, was returning bullish or positive answers. And as we've noted numerous times in this video, it's always important to keep an open and flexible mind because it's only a matter of time before the data begins to shift in some meaningful way. That could occur in 3 days, 3 weeks, 3 months, or 3 years. When we use this type of model, we have no opinion about what tomorrow's hard data will look like. We simply look at the data that we have in hand and ask, are we allocated properly based on the facts? If the answer is yes, or we're not sure, we leave it alone. If the answer is no, we make an incremental adjustment to our portfolios to get back in line with the hard data. No forecasting is necessary about what the data may or may not look like in the future. We're open to all outcomes. And just as the National Hurricane Center tweeted 11 days before Hurricane Harvey made landfall in Texas that there was a medium chance of something developing over the next 5 days, which represented a yellow flag, the hard data in the CCM market model started waving yellow flags 6 to 9 months before Lehman Brothers declared bankruptcy. It's extremely important to note models, including our model, and charts cannot predict the future. Models and charts cannot eliminate risk. Models and charts can help us assess the probability of good things happening relative to the probability of bad things happening. The probability of bad things happening is never zero. The probability of good things happening is never zero. Models and charts can increase the odds of risk mitigation and can add an incredible amount of value when the next inevitable bear market or crisis arrives. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.